Hi, everyone. This is John. Welcome to the next general market update. It's January 6th, 2023. Happy New Year to everybody. Let's hopefully 2003 is a banner year for everyone. So as a reminder, I am an amateur individual growth stock investor, not affiliated with IBD or MarketSmith. The presentation is made by Rain King LLC. So the agenda is we're going to briefly talk about the January effect, just a quick update. Then we're going to spend the majority of our time talking about the bear market, and we want to really be flexible to see both sides of the market. We seem to be at an interesting inflection point, and I'll share some ways to look at the market from both sides. And then we'll talk about Friday's action and the subsequent follow-through day. So the January effect, we talked about this a couple weeks ago. The three components are the Santa Claus rally, the January first 5 days, and the January barometer, which is the monthly performance of the S&P in January. And the January trifecta is when you get a positive indication from all three metrics. If you get a positive trifecta, it's usually pretty reliable. 21 of the last 31 trifectas, 90%, resulted in a positive year for the S&P 500 with average gains of 17%. So where are we? Well, the Santa Claus rally is now in the books. Here's the tally, and the final result was a plus 0.83 gain in the S&P. Since 1969, the average gain was 1.3%. So we get a positive note on the Santa Claus rally. Next up is the first 5 days in January, and here's where we are. We have 2 more days to go. So we'll see where that lands. And again, the January barometer is to be determined at the end of the month. But I would note that we are in a pre-election year, presidential race, and the market is usually up 94% of the time since 1950 on pre-election years in January. So positive sign on the Santa Claus rally. The others are to be determined. We'll keep an eye on it. I will note that this is the seasonal performance of January, which looks at it from 1950. Blue is the last 20 years. Green is the past 10 years. And again, I mentioned black is the pre-election years. And you can see that the performance is very strong in pre-election years in January. Though for the past 20 years, it's not been a great month. So we'll see how it plays out. So let's get into the market in terms of bear market bottoms. I want to do a little bit of a refresher and then provide some new information. So I always tend to look at the long-term chart, and we're still in a situation where these very, very long-term support lines are still in place. The Nasdaq at the 10,000 level is still somehow being maintained amidst all of the volatility. So as a refresher, I shared some of this stuff back in May and I think again in July, but generally bear markets, major bear markets where they're off 25% or more on the S&P, they really end in 2 different ways. Type A, there's capitulation selling on very high volume with a possible really wide range reversal. And type B are these extended downtrends where they continue to grind down and eventually selling dries up and the market goes the other way. And so the 6 previous major bear markets since 1971, here's how they bottomed. You can see that 2 of them had done a type A capitulation selling, where the other 4 were longer term downtrends that eventually became sold out. So we'll have to see where we go from here, but I wanted to use this as a kind of a base to refresh people's memory on how bear markets can end. So the current bear market, to the low in October, we were off 27.5% and 282 calendar days to the low. I won't go over all these statistics again. You've seen them before, but the average loss is about 40%. It takes a long time to get there. And we had mentioned that the average of 7 failed follow-through days in these big major bear markets. And our current follow-through day number sailing was failing, but it was still alive. I mentioned that if you take those major bear markets and look at the percent declines, and I lined them up here, we were over here in 2022, and I had mentioned that it's possible that we have another 15% to go in the S&P, which would bring us down to the almost the 2,900 level to get it down to the 40% range, which is the average major bear market. So taking a look at the Nasdaq for a second, I wanted to share a couple things. First of all, on the right, you can just see this is just representative of the devastation that has occurred in growth stocks. Carvana is down 99% from its peak. Beyond Meat, 95%. Teladoc, 92%. And some of the darlings from the COVID bull market, Snap and Zoom and DocuSign, all off more than 80%. It's almost unthinkable, but that's how devastating bear markets can be. Now, amidst all of that, on the left, I've shown this and I tweeted it out. The Nasdaq composite has been really dragged lower by the big FANG stocks. Apple, Microsoft, and Tesla have really weighed on the index and keeping it down. But under the surface, we showed some signs of life. We were getting higher lows in the Nasdaq's advanced decline line, and the percentage of stocks above the 200-day moving average was gradually improving. So it was showing some life during the week. So it was a good start. Now, this slide is probably the most important slide, I think, in the entire presentation today. So I'll take some time to go through this. This is the Nasdaq on a daily line chart, just looking at closing prices. And in particular, I want to look at new highs and new lows. And from previous videos that I pay attention to this. So when we had the new low at the end of February, we had a 1344 new lows in the Nasdaq. We rallied a little bit, but then we actually undercut. In the undercut, we had 921 lows, and then we rallied. We had a follow-through day, and we rallied in March. We got up to 92 new highs in the Nasdaq, but the market continued for another leg down, and we reached the May lows. And the May lows gave us our largest number of new lows, 1702. So that was a real part of the exhaustion selling that was going on in the market. We had a brief rally, and we came back down and undercut that low in June. And in June, though, you'll notice that the new low started to dry up. We had 1147. Then we got our rally over the summer that ran into August, and we had approximately the same number of new highs as we did in March, 91. And we came back down in the fall, and we had in September, this was late September, we had 1,224 new lows. And then the important part was October 13th was a really important date. I talked about it at the time in these videos, that we hit a new low on the Nasdaq, but the market reversed up on a worse than expected CPI number. So we had bad news on the CPI, but the market had a major reversal. And the number of new lows was 958, significantly lower than the May and June lows. That was a clue of some possible beginning of some divergence. Then we had a rally, from October to December. It was kind of a very choppy rally, not as strong as the ones we saw prior. But the interesting part about it is we had 123 new highs in the Nasdaq on this little rally. And as we know, as we got further into December, the FANG stocks started to roll over. And these last generals of the market, which dominate the Nasdaq composite, were being completely dumped by institutions. And we actually reached a new closing low on the Nasdaq, but we held the intraday low, but on a closing basis, we formed a new low. And look how the new lows has continued to dry up to 502. So we have the June low, and we have the October lows, and then we have this low. And you can see gradually they're getting smaller and smaller, which is a really positive sign. So the summary is, it's really noteworthy. Somehow the index has held the October lows, even with Tesla and Apple and Microsoft and Amazon all selling off. This is a positive divergence, and it shows that there's improving breadth under the surface. And it also might mean that the Nasdaq composite is completely sold out. The selling has been done. Devastation where stocks are off 80 or 90% has been done. So let's take that at the back of our minds as we go forward. So let's go back to some of the bear market bottoms in 74 and 2009. Both of these are extended downtrends where selling dried up. So here's 2009 on a line chart, looking at the Nasdaq on the left and the S&P on the right. And 2009, the financial crisis had a real waterfall, fear-based decline as really the second major leg down. Now, what's important is after it formed its low, there was a retest of the lows. Now on the Nasdaq, and this is important, I looked at this closely, the Nasdaq came down 20.6% in 20 days. And you'll notice that the retest undercut by 2.3%, just barely undercut the previous low. And you can see on the right, the Nasdaq in that same period of time was off 30%. And it took about 42 days to grind down. It undercut the lows by 10.5%. Now, if we look at the 1974 bottom, again, the S&P is on the left, Dow on the right. So the S&P in the 74 had its last final push that retested the lows. It was a 17.2% decline, which is a pretty big, deep decline in only 22 days. The Dow came down 18% in that period of time. Notice that the Dow on the retest just barely undercut. And the S&P was showing some positive divergence, and there was no undercut in that last final push. And we finally got the follow-through day that worked. So we are showing some divergences under the surface. Now, if we look at today's market, again, here's the S&P. The last decline we've seen is we had an 8.8% decline in 7 days, and we've kind of stabilized sideways a little bit, and we had a push on Friday upward. The Nasdaq came down 12% in 12 days, and it's held the October lows. Neither one has undercut the October lows on the retest. So that's a really, really important note when you connect it to what we're seeing in the Nasdaq under the surface. So one scenario is we come back and we retest the lows. And I believe that if we get a retest of the lows from here, there is the potential for the S&P to sell off deeper than the Nasdaq. Because the Nasdaq was the first to lead down, it's really interpreted as being completely sold out. The S&P might have a deeper correction. Commodities and oil stocks have topped out. And I imagine in the first quarter, we're going to see a number of S&P earnings estimates and guidance being lowered. I was checking, if you get a 10% reduction in earning estimates, that would put the S&P somewhere around 3,000 based on historical valuations. Now, interestingly enough, we started with what would be a 40% decline in the S&P, well, the 2,900 level. So there's some levels here that if we have something that's more consistent with a typical major bear market, there's a case to be made. There could be another retest. That's a possibility. And just to keep in our minds, I don't think we're going to see the Nasdaq undercut nearly as deep as the S&P if that occurs. So I think you might go deeper on the S&P, where the Nasdaq might hold up better. Now, what are we looking for in these bottoms? This slide I took from my May 15th video, so why don't we just run through it? Still applies. Rally attempts with breadth improving. We've talked about the breadth improvements in the Nasdaq. We want to see how this occurs as we rally from Friday forward, see what happens. So this is certainly has the potential to be a positive. We want a positive divergence. I just shared with you the new lows analysis that we have a positive divergence on the Nasdaq. Strong follow-through day. The original follow-through day that we got coming off the October 13th low, which was follow-through day number 7, is still in play. And we've had subsequent follow-through days, and we're going to talk about Fridays in a moment. Sentiment at extremes. We definitely have sentiment at extremes, depending on what measure you use. Everybody seems to be very, very bearish. The news is horrible? Check. All of these concerns are still on people's minds. And I've highlighted the last two elements that I think we want to keep our eyes on. I mentioned that you'll see gross names stop going down or even go up on bad news. And that would be a sign, and I said this in May, that's a sign that stocks might be sold out. So earnings seasons is upon us, And these earning reports are coming, and they're going to give us a big clue, I believe, to evaluate. When we get those reports, if there is guidance down, we want to see what the reaction is. The reaction's most important. Does the market shrug off the bad news of lowered guidance and say, we already know that, but we're looking 6 to 9 months ahead? Or has the market not priced in the potential slowdown of an economy and stocks react badly? So it's an important data point to look at through earnings season. Second part, we still want to look for quality bases. We want to look for new names and relative strength. At the moment, I would evaluate this to be still, there's a lot of sloppy action out there. There are some decent charts, but they're not bountiful yet. But you should look at them and look for charts that look positive, showing accumulation, showing relative strength, to see if there are appropriate entries. Again, from the May 15th update, we talked about looking for new leadership. And I had two examples. I showed Netflix in the 2009 low and also Chipotle. So you can see, you can go back to the video to get the analysis, but essentially when the market made new lows, these stocks were actually completing their bases and getting ready to break out. And probably one of the classics that demonstrates the concept well is when you have a long bear market that grinds down, like the 2000 to 2002 bear market. The initial push, you get these big, deep, floppy consolidations, and they usually fail immediately as we make another leg lower in the bear market. Here you have a deep cup. Here you have a faulty double bottom. It's too deep, it's too loose, it didn't undercut. But eventually, things keep tightening and tightening to form a proper base. This is a double bottom, about 23% deep. And so you're looking, and there are some stocks out there right now that have starting to perform this type of pattern where they had a really sloppy base, they held up decently, and now they're starting to tighten up. So I would start to look for those. And if this rally is going to be for real, you could get a significant move if the tide is turned. So let's get a look closer at Friday's action. So I had mentioned that the personal consumption index, the PCE, which is really about consumer spending ability, was probably the key number for the Fed. The CPI index has turned down, which is great, but I mentioned a lot about the jobs. Jobs needs to come down. The Fed needs to get the number of jobs down. Friday's reports showed about 260,000 jobs, which was slightly higher than what was anticipated, but the focus was really on wage growth. Wage growth actually declined, and that was seen very positive by the market. This is something that the Fed wants to start bending down. So they're starting to get more evidence that maybe this is going to start bending down. I think they want to get it to 2.5, which is a long ways away. So here's the Nasdaq. Let's look at Friday's action. Now, the original follow-through day was back in October. Here's the October 13th low. And you'll saw we had a couple of subsequent follow-through days, and then the rally really started to fail. And I've drawn a line under the follow-through day. When you get an undercut of the follow-through day, that's a really bad sign. We came down. Now, this is where we had the closing low on the NASDAQ, but we're still above the intraday low. Now, this follow-through day, number 7, wouldn't officially be dead until the low of the rally day has been undercut, which we have not done, or you have no progress for 13 weeks post follow-through day. And we're about 11 or 12 weeks from the follow-through day. So technically speaking, we still have follow-through day number 7 that's alive. Friday, we had a push of 2.73% in the NASDAQ. Volume, volume was so-so. It was slightly above average. We're still below the 20-day moving average. So the market still has to prove itself. And I think next week's action will be very, very revealing if this rally is going to have any legs, or are we going to turn and just roll over, come back down and really test the lows, as I mentioned, between the two indexes. So we have to keep our eyes on that. Now, we mentioned that, on a follow-through day, you really want to put your toe in the water. And it's kind of like the analogy of fishing in a stream. Every once in a while, you got to go to the stream. You got to throw a line in the water. You don't expect to catch a fish every single time you put your line in the water, but you you certainly want to test things once in a while. So it may be appropriate to start taking some pilot positions, very slowly and measuredly controlling your risk, see if this is truly an inflection. So the summary forward I have is these are from the last update, and they really haven't changed. The Fed doesn't really want a strong market rally. They're still working on bringing inflation down. But we know that the market is looking 6 to 9 months ahead. We had mentioned the labor market, how that was going to be really important to the Fed. And earnings estimates, I described for you earlier about if estimates get lower, we want to see how the market reacts to that type of information. You're starting to see, I'll say, conflicting news reports. You're saying some people say no recession, this is really good. Other people are saying no, there's definitely going to be a recession. So when you see all this conflicting news, just block it out. You need to focus on price. We want to focus on action of the indexes. We want to focus on the action of leading stocks, and that should guide us, not the news. So again, 2023 is a clean slate start. You need to stay engaged with the market, follow day by day, build your watch list, and note where the relative strength is. We mentioned earnings, watching very carefully the reactions. And it's really important that your mindset here at the beginning of the year is in a positive place. And many of you may be discouraged because you took losses in 2022 and you say, this is obviously a bear market and you can't make any money and I'm just going to sit in cash. Sitting in cash is fine, but avoid being comfortable sitting in cash, thinking this market is completely dead. Things can change fast in either direction. And there were a bunch of changes this particular week. We just don't know if they are going to lead to something big or not. So you don't want to get too comfortable and not do your routine and build your watch list, because you will be caught flat-footed if this rally is for real. So what we're going to do at the next market update is we're going to come back to the January effect, and we're going to start really digging in. I mentioned how you want to look at sectors and group rotations to see if we can identify new leadership where the institutions are repositioning the money for this year. So just remember, even though 2022 was tough, not whether you get knocked down, whether you get up. That's a great quote from. So before we wrap up, I just want to remind people that the Boston meetup is going to hold its next meeting next Wednesday, January the 11th. We'll have our annual Rose and Thorn, where traders share one of their best trades, their Rose, and one of their worst trades, their Thorn. And we talk about the lessons we can learn and the rules we can apply to minimize those types of situations. If you want to attend this meeting, go to meetup.com, search the Boston Investors Business Daily Group, and you'll find the information. You must RSVP because seating is limited in this particular Zoom meeting. So I hope to see you there. I want to thank everybody for spending a short part of your day with me. This is the January 6th, 2023 General Market Update. Here's how you can find me on Twitter and YouTube and email. So I'll talk to you soon. Hopefully I'll see you on Wednesday at the meetup. Thanks, everybody.